Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the basics of foreign accounts compliance, asset reporting, and the filing rules. As we get closer and closer to tax season, the amount of fear that clients have increases, and therefore the amount of garbage, fear-mongering articles you find online about everyone going to prison forever increases. It's ridiculous. What we want to do is just kind of bring it down a few notches and explain the basics of what needs to be done. So you've got some foreign accounts, right? Maybe you got a letter from your bank. Maybe you're talking to your buddy and he's like, hey, have you filed your FBAR? And you're like, what is that? One way or the other, you realize you have a foreign account reporting requirement. So why don't we go through some of the basics of the most common forms first. The FBAR is the form you hear about the most: foreign bank and financial account reporting, not limited to just foreign bank accounts. It includes financial accounts, pensions, life insurance, investment accounts, etc., etc. You've got the FATCA, Form 8938, Foreign Account Tax Compliance Act. Form 8938 is filed with your tax return. That FBAR that I just mentioned, that's filed separately. The Form 8938 is filed with your tax return. Those are your two main forms. They primarily, the FBAR only wants the maximum account value. Form 8938 wants the maximum asset value along with some other information. Did you have any income associated with it? Is it a joint account? Etc., etc. More of the basics. Once you get beyond those two forms, depending on what you have, reporting gets infinitely more complicated. Two of the most common forms you'll come across is the Form 8621, which is used to report passive foreign investment companies. Don't ask, it's brutal. We have separate presentations on that, but for most people, it's going to involve their mutual funds and CCOVs and ETFs and things like that, foreign. The 3520 is used to report foreign trust. Many people may not have a foreign trust, but they have a foreign pension plan. Foreign pension plans are typically considered foreign trusts. They're employment trusts. You've got the owner, the grantor, you've got the beneficiary, and you've got the trustee. The IRS has various exceptions, like the RRSP is automatically accepted from having to report. A revenue procedure came out, a RepRoc 2020-17, that exempts certain retirement and non-retirement tax-deferred trusts. There's various requirements to meet those exceptions. It's not just you have a foreign pension, so it automatically falls under revenue procedure 2020-17, but it's food for thought, right? The most important thing with these forms is don't be late, if possible. Being late is bad from the IRS's perspective. You've got the FBAR, which is filed directly on the FinCEN, Financial Crimes Enforcement Network website, and it's due. Normally, it used to be due in June, then they changed it to April, and now it's still on automatic extension, at least at the time of this presentation. So you would have until October to file. The Form 8938, the other very common form, is actually part of your tax return. So it's due when your tax return is due. If you file an extension for your tax return, the Form 8938 goes on extension as well. The Form 3520A, foreign trusts, is a little more complicated because that's generally due when you figure out the equation. It's normally March 15th, depending, right? So when you've got the 8938, for example, let's take a step back. For the FBAR, automatic extension, don't need to file any extension form. The 8938 goes on extension with your tax return. So if you're filing your tax return, you do an extension, Form 4868. The Form 8938 goes automatically on there. You don't have to do anything additional. For some of the forms, like the 3520A, you have to file a separate extension form, which is Form 7004. Important to make sure you get that done before the due date, which ordinarily is March 15th. What happens when you don't file? So there is this incredible amount of fear-mongering and scaremongering online about the criminal penalties and you're going to go to prison forever. Say goodbye to your children and your dog because you're never going to see them again. You forgot the account on your FBAR that your grandma left you in Peru, right? It doesn't work that way. 99% of the time, if you get penalized, it's going to be a non-willful penalty. For the FBAR non-willful penalties, it varies depending on what jurisdiction you're in and what other courts have held, but it's basically a warning letter all the way up to $10,000 per account per year that adjusts for inflation. Some courts have said you can only limit it to one penalty per form. Other courts have said you're not limited by that. The revenue manual basically limits it to up to 50% maximum value, so it doesn't exceed the willful penalty. Most of the time, you can get away from the penalty by doing the offshore disclosure programs, which we'll talk about in a second. If you do get hit with a penalty, it's normally the $10,000 to $60,000 penalty, and if it's your first time, they will normally the agents have some discretion to reduce that penalty. Okay, so don't think you're automatically screwed, for lack of a better word. If you don't file on time, you could be subject to an audit. They're becoming way more common for the FBAR. It doesn't mean you're going to be audited specifically on the FBAR. A very common scenario we come across, taxpayer has several foreign accounts in different countries because they're either an investor in different countries or they're a consultant. It's just easier to handle local currency. And then at that time, their accounts might have been low when they first started, then the accounts went up in value. Now they're subject to the $10,000 reporting, maybe even FATCA, and they never file. So they're in an audit, and then they're asked if they have foreign accounts, and then they identify that they do. They didn't even know they had anything to do about it. Next thing you know, they're penalized. Special agent investigation is a little more complicated. If the IRS thinks there's fraud involved, you could become subject to a special agent investigation. They're a lot less common, especially with the limited resources. Most of the time, if it's foreign account related, it's going to be because there's some other stuff going on, structuring, smurfing, money laundering, some other type of crime. And the foreign account is just another aspect of it. If you ever look and see when someone's being indicted or there's a complaint filed in criminal court, it's because there's other issues. It's not just because they missed an account. So if you're out of compliance and you're seeking to get into compliance before all this happens, there's various programs you can use. If you're willful, they even have a program for it. It's the Voluntary Disclosure Program, VDP. It's been around forever. There used to be OVDP, which was specifically for offshore. They got rid of that program September 28th, I think, 2018. And now everyone who's willful does VDP. If you're non-willful, you could do the streamlined programs. You could do reasonable cause, and you could do delinquency. The programs have their various pros and cons to them. We have many different presentations that you can listen to, a whole bunch of different articles on our websites that you could read about. If you're interested, you can always schedule a reduced fee initial consultation if you think it's appropriate. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.